we're going to explore shakeouts, or should you be getting out? Now, shakeouts are violent drops that catch a lot of the weak holders and get them knocked out of a stock, and they reverse back up very, very sharply and quickly. So shakeouts can scare you out based on the price action, or sometimes they take time and they wear you out. Weekly shakeouts can be more meaningful than daily shakeouts, but we want to look for both. Now, most big winning stocks will have a few shakeouts along the trend over the course of a 12 to 18 month move. Now, mysteriously, these shakeouts occur. They're very hard to understand at times, and they definitely can be very, very frustrating on your mental capital if you get shaked out of a position that you enjoy. Typical characteristics: a couple of wide range bars that occur. A stock might close 40% or more off of its lows, showing that there actually is support for the stock. They're usually associated with very big volume. It can look very, very bad on the sharp decline. They can be scary looking. They undercut an obvious level of support, and most shakeouts have a very distinct V shape. Now, shakeout or pullback, it's difficult in real time to know if something is a shakeout or if it's some sort of normal pullback. Pullbacks generally are orderly declines that are very gradual into a moving average or even to the lows of a base. There's generally no undercut with pullbacks of the previous lows, where shakeouts can be much more sharp, violent declines, and there's undercuts of support areas shaking out people, and they usually have very quick recoveries. We pay attention to those, particularly if we get knocked out. We may have to have the courage to get back into the stock. Now, institutions and retail traders use different tools. Our retail traders use technical analysis, where institutions are using valuations of stocks. Retail traders are very small in size, so they can get in and out of the market very quickly, like a little speedboat, where institutions have very big size, big footprints, and they're really like a slow-moving tanker. The retail trader will use the simple 50-day moving average, where institutions will use the 65-day. Retail uses the 200-day simple. Institutional trader will use the 100-day moving average. So the retail traders are really the caboose on the train. They follow the engine. They try to hop on board and get into a trend, where the institutions are the actual engine. They drive the market. They drive the stock price.
Watch part 2 by clicking on the link below. Join RainKingInsights.com for more educational content and trade ideas.